Market volatility is unavoidable, but how you react to it determines your long-term results. Buffett, the Oracle of Omaha and longtime chair of Berkshire Hathaway Incorporation, is one of the world's most respected investors. He has spent decades sharing his financial words of wisdom and offering perspective during periods of market volatility. His approach isn't about complex strategies or fast trades, but about discipline, patience, and confidence in businesses that endure. Buffett reminds investors that buying a stock means owning part of a company and not a symbol that bounces on a screen. He evaluates businesses based on fundamentals like pricing power, durable advantages, and management quality, not day-to-day market moves. You should be unconcerned about short-term price action when you own the securities directly. I think about them as businesses, not stocks, and if the business does all right over the long term, so will the stock. Buffett wrote in his December 5, 1969 letter to his partners. For example, his long-standing stakes in Coca-Cola Company are proof of how he applies this mentality to his business. Berkshire acquired a significant stake in Coca-Cola in 1988 and has maintained its stake in the business ever since, despite the company's decades of ups and downs. He expected to hold those positions for a long time, and he's delivered on that promise. Berkshire is always a buyer of both businesses and securities, and the disarray in markets gave us a tailwind in our purchases. This was the letter from Berkshire to its shareholders during the financial crisis of 2008. It reminded shareholders that market downturns allow investors to buy good companies at bargain prices. Buying when panic pushes prices below a stock's intrinsic value ties directly into another timeless piece of Buffett's advice. Be fearful when others are greedy, and greedy only when others are fearful. By controlling your emotions, you can channel your fear to seek out investment opportunities when other investors might be looking away. Buffett's willingness to lean in while others pulled back has helped define Berkshire's growth. By staying patient during recessions, he turned fear-driven sell-offs into decades of gains. Buffett frequently urges patience when investing in any business. In his letter to shareholders, Buffett explained that we are just the opposite of those who hurry to sell and book profits when companies perform well. His advice is simple. Stay invested in strong companies and let time and compounding do the heavy lifting, rather than engaging in relatively short-term trades in pursuit of quick profits. Buffett structures Berkshire to hold significant cash reserves precisely so he can act when opportunities arise. In Berkshire's 2008 shareholder letter, he highlights excess liquidity as a core strength, maintaining Berkshire's Gibraltar-like financial position, which features huge amounts of excess liquidity. Liquidity can be viewed as both a defensive tool and an offensive one. With cash in hand, Berkshire doesn't have to sell assets in a crisis and can buy worthwhile assets when the right opportunity arises. Individual investors can replicate this on a smaller scale by keeping cash on hand to buy attractive securities that have significant upside potential when their stock price is temporarily depressed below its true value. Buffett rarely dwells on forecasts or headlines. Media-driven fear and daily market chatter can distract from what matters most: long-term business performance. When we own portions of outstanding businesses, our favorite holding period is forever, he wrote in 1989. That illustrated his rejection of trading in response to short-term events in the market or broader economy. By staying above the noise and trusting in strong businesses, investors can reduce risky or emotional investment decisions, he advised. Remember, every step forward counts. Thanks for being part of this journey. Subscribe and stay tuned for more stories that inspire and empower. Until next time, keep shining.